Welcome to Finance Architects. Why markets crash? Why seemingly stable economies spiral into chaos? Welcome to the intriguing world of behavioral finance, a field that dives deep into the psychology behind financial decisions and market movements. Consider the dot-com bubble of the late 1990s. This was a time when the digital frontier was expanding at an unprecedented rate. Investors, driven by what Alan Greenspan famously termed irrational exuberance, poured vast sums of money into internet companies. Many of these companies, despite generating zero profits, saw their stock prices skyrocket solely based on potential. However, by the early 2000s, reality took hold, and the bubble burst spectacularly. Stock values plummeted, wiping out trillions of dollars in market value almost overnight. Now, shift to the 2008 housing market crash. Here, a similar tale of overconfidence played out, but this time in the housing sector. Financial institutions and homebuyers alike believed the market would continue to rise. Driven by this belief, more and more loans were issued, including to those who were less likely to afford them. When people began defaulting on their mortgages, panic ensued. The rapid selling of assets, fueled by fear, led to a global financial crisis. These case studies illustrate that behind every financial decision, there is a human element, often driven by emotions like greed and fear. Traditional financial theories have struggled to account for these human elements, which is where behavioral finance steps in. It helps us understand that markets do not always behave rationally because humans do not always behave rationally. In conclusion, behavioral finance doesn't just provide insights into why bubbles form and markets crash. It sheds light on the broader spectrum of human behavior in financial markets, helping investors, policymakers, and academics understand and hopefully predict market anomalies. Next time you observe a market anomaly, remember, it's not just numbers, it's human nature in action.